Welcome to the deep dive. If you've got that big insurance exam coming up, well, think of this as your essential last-minute study buddy. We're aiming to cut straight to the core stuff you really need. We have a fantastic set of sources here, and our mission today is basically to pull out those key nuggets of knowledge. Consider it your guided tour through the absolute must-knows for the exam.
Exactly. And it's not just about memorizing facts, is it? The goal is really to see how these concepts, well, how they all connect. Understanding those links makes the material stick, makes it much more useful than just cramming.
Definitely. So let's kick things off by jumping back in time a bit. It's always kind of surprising how far back the roots of insurance actually go.
Well, absolutely. I mean, the core idea, pooling risk, you can trace elements back to the 4th century. We see these early forms like bottomry bonds and respondentia bonds.
Right, bottomry and respondentia. How did they work, essentially?
Well, imagine a ship captain needing cash for a voyage. A bottomry bond was basically a loan using the ship itself as collateral. Respondentia used the cargo. But here's the clever bit.
Okay.
The loan only needed repaying if the ship actually made it safely to its destination. If it sank, well, the debt was canceled.
Ah, so the lender took on the risk.
Precisely. And because they took that risk, they charged a bit extra on top of the interest, sort of like an early premium, you could say.
Fascinating. And then fast forward a bit. London coffee houses. Here's where it gets really interesting. Who'd have thought a coffee shop would basically invent modern insurance?
It's an amazing story, isn't it? Edward Lloyd's place, opened around 1680, just became this hub. Merchants, ship owners, they all gathered there.
Not just for coffee, then.
Definitely not. They talked voyages, auctioned ships, and crucially, found people willing to underwrite the risks for their ships and cargo. So quite informal at first.
And that evolved into...
Over time, it formalized. By the 18th century, it had become Lloyd's of London, the global name we recognize today, still seen as one of the strongest insurance organizations anywhere.
That's quite the journey, from coffee beans to global finance. But what about closer to home for many of our listeners? How did insurance take root and develop in, say, Bangladesh?
Right. Well, the history there is quite dynamic, too. Under British rule, you started seeing some insurance companies, mainly life insurance, operating in the Indian subcontinent, which included Bangladesh then.
Okay, so it had early roots there, too.
It did. Then, during the Pakistani period, 1947 to 71, it grew quite a bit. You had nearly 50 companies doing both life and general insurance business.
50 companies, wow.
Yeah, quite active. But then a big shift after independence in 1972. The new Bangladesh government nationalized the whole industry. The Bangladesh Insurance Nationalization Order, 1972.
So everything became state-owned?
Initially, yes. All those private companies were merged into 5 state corporations, 3 for general, 2 for life. Okay. But that structure didn't last long. It was streamlined pretty quickly. By 1973, those 5 were basically consolidated into the 2 main corporations we still hear about. Saharan Bima for general insurance and Jiban Bima for life.
Okay, so 2 big state players. Did private companies ever come back?
They did. From 1984 onwards, responding to public demand and the need for more specialized products, the private sector is allowed back in. Now you've got around 60 private companies alongside the state ones.
And supporting all this growth.
Crucially, the Bangladesh Insurance Academy was set up in November 73. There was a real shortage of trained people, so its job was, and still is, professional education, research, training, building that expertise.
That's a really helpful timeline. So all this history, all these structures, what does it actually mean when we talk about insurance versus assurance? Are they just synonyms, or is there a core difference we need to nail for the exam?
Excellent question. And yes, a very important distinction. Insurance is generally understood as a contract of indemnity.
Indemnity, meaning making good on a loss.
Exactly. Think of it like trying to put you back in the exact same financial spot you're in just before something unexpected happened. A fire, a car crash, uncertain events. It indemnifies you against a potential loss, neither better nor worse off financially.
Okay, so that's insurance. What about assurance?
Assurance usually refers to things like life and personal accident policies. And these are not contracts of indemnity. Why? Because, well, you can't really put a price tag on a life or a limb, can you?
Right, makes sense.
So instead, an assurance policy pays out a pre-agreed sum when a certain event happens. Death, for example, is certain eventually, even if we don't know when. That's why it's whole life assurance. Or reaching a specific age in an endowment assurance.
So the key is certainty versus uncertainty.
That's the core difference right there. Insurance tackles the financial consequences of uncertain events. Assurance deals with the financial outcomes of certain events, even if the timing is unknown. Grasping that is fundamental.
That really clarifies it. And talking about uncertainty brings us right to risk itself. That's the absolute heart of the insurance business, managing risk. How do insurers even start to handle that?
It really is the core challenge. Risk, you could define it as a uh, probable, disadvantageous, undesirable, or unprofitable outcome of a fortuitous event. Fancy words. But basically, the chance of something bad happening unexpectedly.
And managing it.
Well, there's several methods, about 7 key ones, really. First, you've got risk avoidance. Simple enough, just don't do the risky thing.
Okay, avoid it. What else?
Then risk prevention. That's about actively trying to stop the loss from happening, like installing sprinklers or minimizing it if it does happen. Next is risk assumption, or self-insurance, basically deciding you'll cover any loss yourself.
So taking it on yourself.
Right. Then risk distribution, spreading the risk across a group, like in a partnership or a company structure. Hedging and neutralization is more financial, offsetting a potential loss with a likely gain elsewhere.
Like in the stock market.
Sort of, yeah. Then there's elimination of risk, which is about fundamentally changing how things are done to remove the risk altogether. And finally, the big one for us, risk transfer.
And that's where insurance comes in.
Exactly. Risk transfer is where one party guarantees another against the specific risk of loss. And insurance is by far the most common and developed form of risk transfer.
Out of all those methods, which one do you think maybe gets overlooked the most, or is perhaps the hardest to really get right in practice?
Ooh, that's a good one. Well, risk transfer via insurance is obviously huge, but I think risk prevention, its potential, often gets underestimated.
Really? Why is that?
We tend to focus a lot on paying claims after something happens, but really robust, proactive prevention, constantly improving safety processes, can massively reduce how often losses happen and how bad they are. It's just
Well, its benefits are harder to measure immediately compared to an insurance payout, so maybe it gets less focused than it should. That makes sense. So connecting this back, the law of large numbers, that sounds pretty central to how insurance, especially risk transfer, actually functions, doesn't it? Like some kind of statistical magic trick.
it really is the bedrock.
Yeah.
It's not magic, but it's a fundamental statistical principle that makes insurance possible. The law of large numbers essentially says the greater the number of instances considered, the more likely the actual results will approach the expected results.
Okay, translate that for me.
Right. Think about flipping a coin. Flip it 10 times, you might get 7 heads, but flip it 10,000 times, and you'll get extremely close to 50% heads, 50% tails. The more times you observe something random, the more predictable the overall outcome becomes.
So how does that apply to insurance?
Insurers aren't insuring one house against fire. They're insuring thousands or millions. For any one house, a fire is unpredictable. But across a huge pool of houses, the law of large numbers allows insurers to predict, with remarkable accuracy, roughly how many fires are likely to occur in a given year.
Ah, so it makes the unpredictable predictable in bulk.
Exactly. It lets them forecast losses across the group, which is absolutely crucial for calculating premiums and ensuring they have enough money set aside to pay claims. Without it, setting a fair price for insurance would be pure guesswork.
Okay, so the law of large numbers helps predict how many losses, but what about how, well, bad those losses might be? How risky is a risk in terms of its potential impact?
Right. That's where 2 other key concepts come in, risk frequency and risk severity.
Frequency and severity.
Yep. Frequency is just how often a particular type of loss happens. Severity is how much it costs, on average, when that loss does happen.
And how do they relate?
Generally, there's often an inverse relationship. Things that happen frequently, like minor scratches on a car, tend to have low severity. They don't cost much to fix. Things with potentially high severity, like a major factory explosion, hopefully have very low frequency.
Hopefully. Is that always the case?
Not always. In some high-risk areas, like maybe petrochemicals, you could unfortunately see a positive correlation where things go wrong relatively often and cost a huge amount when they do. That's obviously a very difficult risk profile for insurers.
This brings up an important point. How do we sort of visualize the relationship between small incidents and really major ones? It feels like we focus on the big disasters, but maybe the small stuff matters more than we think.
Absolutely. And there's a great model for this, the Heinrich triangle, or sometimes called the safety pyramid. It came from analyzing industrial accidents.
Heinrich triangle, what does it show?
It shows a ratio. Based on studies, for every one major injury, like a fatality or a serious disability, there are roughly, say, 30 minor injuries requiring first aid. and maybe 300 incidents that cause no injury at all, near misses, unsafe acts, or conditions.
Wow, 130,300. That's a steep pyramid.
It is, and the implication is huge. It suggests that major accidents don't just happen out of the blue. They're the tip of the iceberg, built on a foundation of many more minor incidents and near misses.
So tackle the small stuff to prevent the big stuff.
Precisely. By paying attention to and addressing those hundreds of near misses and minor issues, you're effectively cutting off the potential pathways that could lead to a major event. It highlights the massive importance of proactive safety culture and dealing with risks at the lowest level.
That's a really powerful visual. It shows insurance isn't just about claims. It connects to prevention and safety too. And thinking bigger picture, what are the broader ways insurance contributes, to the national economy beyond just helping individuals?
Oh, its role is huge, often unseen. We talk about the general functions of insurance. These aren't specific policy types, but broader contributions. First, the most fundamental, equitable distribution of loss. Spreading one person's large loss across many people through premiums, it makes catastrophic individual losses manageable for society.
The core pooling idea, again.
Exactly. Then there's crucial assistance to business enterprise. Think about, could a large company invest millions in a new factory if they couldn't insure it against fire or other perils? Probably not. Insurance allows businesses to transfer major risks, freeing up their capital for growth and investment, knowing they can recover from disasters.
Right. It enables risk-taking for growth.
Definitely. It also acts as an invisible export. When a country's insurers provide services abroad or take on reinsurance from other countries, that brings foreign currency in, helping the balance of payments.
Okay, interesting. What else?
Investment. Insurers collect vast sums in premiums. After setting aside reserves for claims, they invest this money, often called the float, into the economy. Government bonds, mortgages, company shares, infrastructure projects. This is a massive source of capital, especially long-term capital from life insurers.
So they're major investors.
Huge investors. They also provide inspection services. Insurers often survey properties or operations they cover, identifying risks and recommending improvements. This helps reduce losses not just for the client, but for the nation as a whole by promoting safety.
Proactive loss reduction.
Yes, which ties into reduction of losses, directly through things like pricing. Insurers charge higher premiums for higher risks and offer incentives like no-claim discounts for good records. This encourages people and businesses to be more careful. And finally, research and publicity. Insurers invest in understanding risks better and educating the public about safety, again, reducing overall losses for the community.
It really does touch almost every part of the economy, doesn't it?
It underpins so much. It provides stability, facilitates trade, encourages investment, and promotes safety. Its economic contribution is really profound.
And underpinning all these functions, all these benefits, is the insurance contract itself. So, okay, let's unpack this. When we say insurance is a contract, what kind of contract are we actually talking about legally?
All right, good question. Legally, most insurance contracts fall under the category of simple contracts.
Simple contracts, as opposed to
Specialty contracts. Specialty contracts are very formal. They usually have to be in writing, signed, sealed, and delivered. Think of things like deeds for land transfer. They have specific formal requirements.
Okay, so insurance isn't like that.
Generally, no. Simple contracts are less formal. They can be oral, although obviously having them in writing is much better for clarity. But the key is they need certain essential elements to be valid. An offer, acceptance, consideration.
Consideration meaning something of value exchanged.
Exactly. Your premium payment is consideration for the insurer's promise to pay claims. You also need consensus ad item, a meeting of minds. Both parties agree on the terms, plus legal capacity of the parties and a legal purpose for the contract. Insurance fits this simple contract model.
Got it. Now, here's where it can get tricky. What happens if someone wants to transfer their policy, or maybe just the payout from it, to someone else?
Ah, yes. Assignment. That's the legal term for transferring rights and sometimes obligations under a contract to a third party. And in insurance, it's crucial to distinguish between two types.
Okay, what are they?
First, there's assignment of policy proceeds only. Here, the original person insured, the policyholder, stays the same. They just direct that if there's a claim payout, the money goes to someone else, maybe a bank that loaned them money. The policy itself doesn't change hands. It's simpler, not really assigning the contract.
Okay, just the money goes elsewhere. What's the other type?
The other is a true assignment of policy. This is where the actual rights and obligations of the contract are transferred. The original policyholder is essentially replaced by a new one. This is a much bigger deal legally.
Right, because the insurer now has a contract with someone new. How does this play out in different types of
It
insurance?
varies a lot and often brings in another concept, novation.
Novation.
Novation is basically substituting a new contract for an old one, or substituting a new party for an original party, requiring the agreement of all involved. It often happens in insurance instead of simple assignment. For example, fire and accident insurance. These are generally considered personal contracts.
Personal, meaning based on the specific person insured.
Exactly. The insurer based their decision, the premium, the terms on you, your history, how you maintain the property. So if you sell the property, you usually can't just assign the policy to the new owner.
So what happens?
The new owner needs to get their own insurance, or the insurer might agree to cancel the old policy and issue a new one to the new owner, possibly on different terms. That process of creating a new contract with the new party is essentially novation, not assignment of the old one.
Okay, so fire and accident are tricky. What about marine insurance?
Marine is different, especially for cargo. Under the Marine Insurance Act, policies covering cargo are generally freely assignable. Why? Because the risk is mainly tied to the goods themselves, not so much the owner's personal characteristics.
So if the cargo changes hands mid-voyage, the insurance can follow it.
Pretty much, yes. But for hull insurance insuring the ship itself, it's more restricted. The owner and operator's reputation does matter there, so assignment is less common, and changes in ownership often lead to novation again.
And life insurance.
Life insurance is interesting. You can assign the policy proceeds. The person whose life is insured obviously stays the same. And importantly, the person receiving the assignment, the assignee, doesn't need to have an insurable interest in the life insured at the time of assignment.
Right, because the insurable interest was established when the policy was first taken out.
Exactly.
This raises another important comparison. How is an insurance contract fundamentally different from just, well, a bet, a wager? Both involve uncertainty, money changing hands.
A classic exam point. And the differences are critical. First, validity. Insurance is a legally valid, enforceable contract. A wagering contract, like a bet on a horse race, is generally void. You can't sue someone in court to collect on a bet.
Okay, valid versus void. What else?
Good faith. Insurance demands utmost good faith of bona fides from both sides. Full disclosure is required. Wagering doesn't have that requirement. Also, the event. An insured event, like an accident, could happen multiple times during a policy term. A wagering event usually happens just once.
And the core principle we discussed earlier.
Insurable interest. Absolutely vital for insurance, you must have a financial stake. Not required for a wager. You could bet on anything. Then there's indemnity. Insurance aims to compensate for actual loss, not provide a profit. Wagering is all about winning or losing money. No indemnity involved.
Any other distinctions?
Yes, in insurance, the policy provides immunity from loss for the insured regarding the covered event. A wager offers no such protection. And finally, the desired event. In insurance, the insured event, fire, accident, is not desired. You don't want it to happen. In a wager, you absolutely do want the event you bet on to happen so you can win. These differences clearly separate the two.
Okay, let's really unpack that duty of disclosure you mentioned. We often hear caveat emptor, let the buyer beware in normal shopping, but you're saying insurance is different, much higher standard.
Absolutely, fundamentally different. In regular commerce, say under the old Sale of Goods Act principles, a seller generally doesn't have to point out every single flaw. Section 14.1 basically said the buyer takes the risk unless the seller actively deceives them. Section 14.2 offered a bit more protection if the buyer specifically relied on the seller's judgment about suitability, and the seller knew of a defect, but it's still limited. The seller could often just stay silent.
But not in insurance.
No, because in insurance, the product is intangible. The insurer can't physically inspect the risk in the same way you can inspect a car before buying it. They rely almost entirely on what the person seeking insurance tells them.
So honesty is paramount.
Utmost honesty. Both parties have a positive duty to voluntarily disclose all material facts. And a material fact is anything that would influence the judgment of a prudent underwriter in deciding whether to take the risk, and if so, at what premium and on what terms.
And this duty applies when?
It applies throughout the negotiation phase, right up until the contract is finalized. And some argue it continues, meaning you need to disclose material changes during the policy term, too.
What kind of things must be disclosed?
Generally, anything that makes the risk greater than it would normally appear. Maybe several circumstances, unusual hazards. Also things like a history of many previous claims, Or if you're seeking exceptionally high coverage compared to the value gross over insurance, suggesting a moral hazard. Anything out of the ordinary about the risk.
Okay. And what doesn't need to be disclosed unless they specifically ask?
Good point. You generally don't need to disclose things that lessen the risk, or things that are common knowledge, or matters of law. Also, facts the insurer ought to know or could reasonably find out themselves through survey or inquiry, or facts covered by a policy warranty. The focus is on facts only the proposer knows that are material to the risk assessment.
This brings up a crucial question then. Can you insure just anything you happen to see? Like, could I insure my neighbor's car because I like it?
Huh. No, definitely not. And that leads us straight to the principle of insurable interest. It's fundamental. You, the insured, must possess an insurable interest in the subject matter of the insurance.
And what does insurable interest actually mean?
It means you have a legal or equitable relationship to the thing being insured, such that you stand to benefit from its preservation and would suffer a financial loss from its damage or destruction. It's about having a real, measurable financial stake. Without it, the contract is just a wager, and it's void.
So who typically has insurable interest? Give us some examples.
Sure. The most obvious is ownership. You own a house, you have insurable interest. Part owners have it to the extent of their share. Both mortgagees, lenders, and mortgagors, borrowers, have it. Bailees, like warehouses holding goods and carriers transporting them, have it due to their responsibility.
What about people?
Husbands and wives are generally presumed to have insurable interest in each other's lives. A creditor has an insurable interest in their debtor's life, but usually only up to the amount of the debt. Insurers themselves have it when they take out reinsurance. And anyone facing a potential legal liability, like under third-party motor insurance, has an interest in insuring against that liability.
Okay, that's clear. Now, when must this insurable interest exist? Does it have to be there right from the start?
This is a key detail, and it varies. For marine insurance, interest generally needs to exist at the time of the loss. You might not have it when you take the policy out, but you must have a reasonable expectation of acquiring it.
Different for other types.
Yes. For fire insurance, you typically need insurable interest, both at the time you take out the policy A&D at the time of the loss. Same for accident insurance.
And life insurance.
For life insurance, the insurable interest only needs to exist at the time the policy is effected. It doesn't have to exist at the time of the claim. Think about taking out a policy on a business partner. The interest exists then. If the partnership dissolves later, the policy can still remain valid.
Those timing differences are really important to remember. Okay, let's unpack another core principle, the principle of contribution. You mentioned it connects to indemnity. How so?
It absolutely does. You can think of the principle of contribution as a direct consequence or a corollary of the principle of indemnity. It applies specifically to indemnity contracts like fire or property insurance.
And its purpose?
Its purpose is to stop someone from profiting from a loss by claiming the full amount from multiple insurers. If you have, say, 2 fire policies on your house with 2 different companies and your house suffers damage, contribution ensures that the insurers share the cost of the claim proportionately. You only get indemnified for your actual loss once.
Prevents double recovery. Makes sense. What conditions need to be met for contribution to apply?
Right. There are some basic conditions. First, there must be more than one policy in force covering the loss. Second, all the policies must cover the same subject matter. Third, they must all cover the same peril that caused the loss. And fourth, critically, they must all cover the same interest of the same insured.
Can you give an example of that last point, same interest?
Sure. Imagine a building owned by person A, but leased to person B who runs a business there. Both A, as owner, and B, as tenant responsible for damage, might have separate insurable interests and take out separate fire policies. If there's a fire, their 2 policies wouldn't necessarily trigger contribution between A and B's insurers because they cover different interests, ownership versus liability leasehold. Contribution applies when one person has multiple policies covering their single interest.
Okay, got it. Could you walk us through a quick calculation example?
Definitely. Let's say you have a property insured against fire with 3 companies.
Sum insured equals 1,000.
Sum insured equals 2,000.
Sum insured equals 4,000. So the total sum insured across all policies is 1,000 plus 2,000 plus 4,000 plus 4,000 equals 7,000. Now imagine there's a fire causing a loss of 700.
Okay, loss is 700.
Under contribution, each policy pays its proportion of the loss based on its proportion of the total sum insured. Policy A pays 1,000, 7,000, 700 variables 100. Policy B pays 2,000, 7,000, 700, 200. Policy C pays 4,000, 700, 700, 4,000.
And the total paid is 100 plus 200 plus 400 plus 700.
Exactly. The insured gets the full 700 needed to cover the loss, but no more. And the insurers share the burden fairly based on the amount of cover they each provided.
Very clear. So, final point on principles. What about a valued policy? Does that stick strictly to this indemnity idea, or is it seen as maybe a bit of a departure, and why?
That's an excellent question, often debated. A valued policy is generally considered a departure from the strict principle of indemnity.
A departure. Why?
Because in a valued policy, the value of the insured item, say a rare painting or a classic car, is agreed upon by both the insurer and the insured at the start of the policy. This agreed value is written into the policy.
You know, it's fixed up front.
Right. If a total loss occurs, the insurer pays that pre-agreed value, regardless of whether the item's actual market value might have gone up or down slightly by the time of the loss.
So it's not strictly based on the value at the time of loss, which is the core of indemnity.
Exactly. Indemnity aims to put you back in the financial position just before the loss. A valued policy pays the value agreed at inception. While that agreed value should be realistic when set, it means the payout isn't tied to the precise market value at the loss date. That's why it's seen as a modification or departure. They are used, but typically only for items where establishing market value after a loss might be difficult, like unique items, and their issuance is quite restricted.
That wraps up the key principles nicely. Wow, we've covered a lot of ground from 4th century bonds and London coffee houses, through risk management techniques like the Heinrich Triangle, the huge economic role of insurance, and deep into the legal nuts and bolts of contracts, assignment, disclosure, interest, and indemnity.
We certainly have. And if you followed along, you've really built a strong framework. Understanding how these pieces fit together, the history, the risk concepts, the legal principles, that's what gives you confidence. It's more than just facts. It's seeing the whole picture.
Absolutely. So connecting this all together, you're not just memorizing for an exam, you're genuinely grasping how this vital industry functions. Which leads to a final thought, perhaps.
Indeed. Thinking about all this, the history, the principles, how will you, listening now, apply this deeper understanding, maybe in your career, your own financial planning, or just seeing the world around you through a slightly different lens now you understand the mechanisms of risk and protection?
A great question to ponder. Take these insights, feel confident about that exam, and see how these concepts play out everywhere. Thanks for joining us on the Deep Dive.